On a Tuesday morning in May 2025, the Kohl's board fired its new CEO, Ashley Buchanan, after roughly 100 days. An investigation found he had steered the company into vendor deals tied to an undisclosed personal relationship. He walked out of one of America's largest retailers, having run it for less time than a single baseball season. His resume was spectacular, built on decades of merchandising experience at Walmart and Michaels, yet none of those credentials prevented the failure. This is a recurring pattern in the corporate world. 2 out of every 5 new CEOs fail within their first 18 months on the job. This chart tracks the S&P 1500, visualizing the financial toll of poorly managed C-suite transitions. Forced exits, written down equity, and collapsing trust destroy close to $1 trillion a year in shareholder value. These staggering losses suggest a systemic error in how corporate boards select leaders. They are tallying up visible credentials while ignoring the traits that actually predict success. This CEO iceberg illustrates flaws in current selection. Boards hire for what sits above the waterline: Ivy League degrees, big company titles, and a polished presence. But actual performance is dictated by traits below the surface: self-awareness, integrity, and the capacity to admit error. Search committees continue to weight the 10% of traits that are easy to detect in a room. Those visible markers have zero correlation with a leader's ability to survive a corporate crucible. The CEO Genome Project analyzed 17,000 executive assessments. Isolating 2,000 successful CEOs challenged the standard playbook. Only 7% were Ivy League graduates. 8% held no degree. Astonishingly, 45% had survived a major career blow-up, like being fired, and still reached the top. The trait that actually predicted success was execution discipline. Candidates who scored high on reliability, simply doing what they said they would do, were 15 times more likely to succeed once they took the chair. Pedigree and charisma are useful for getting hired, but execution discipline and follow-through are the variables that dictate firm performance. The doctrine of resilience identifies 3 specific traits in successful leaders: facing reality without flinching, finding meaning in the work, and improvising when plans fail. This contrast is visible in recent corporate history. While polished outsider hires struggled with market shifts, Mary Barra has maintained a steady, highly successful 12-year tenure at General Motors. Barra took over as CEO in early 2014, just weeks before a massive ignition switch crisis that resulted in the recall of 30 million vehicles. She passed the test by living the company's values while operations were under extreme pressure. By 2024, GM had beaten Wall Street earnings forecasts in 34 of the previous 35 quarters. True resilience is often invisible on a balance sheet until a company faces an existential threat. Bill George, the former Medtronic CEO, who now teaches at Harvard, argues that the hardest person a leader will ever have to lead is themselves. When Satya Nadella inherited Microsoft in 2014, the company was profitable, but the internal culture had been hollowed out by hyper-competitive stack ranking systems. Nadella avoided the standard strategic spreadsheet transformation. Instead, he changed his own mindset, asking the company to move from know-it-alls to learn-it-alls. This internal shift allowed Microsoft to embrace Linux on Azure and put Office on iPhones. Over 11 years, the company's market cap grew from $300 billion to $3 trillion. Nadella's performance suggests that visionary strategy is often simply the projection of a leader's internal compass out onto the open market. Data from the McKinsey Global Institute shows that long-term operators average $7 billion more in market capitalization than their short-term peers. Despite this, boards often revert to installing cost-cutters. Boeing serves as a cautionary tale. Over 20 years, a sequence of finance-first CEOs prioritized stock buybacks over engineering excellence. The company spent over $41 billion buying its own shares, while capital expenditure fell below 2% of sales. The result was a total cultural drift that eventually cost the company $33 billion in core operating losses. Jensen Huang at NVIDIA took the opposite path. He endured years of investor skepticism and depressed margins to build the platform for the AI revolution. By fiscal 2025, 88% of NVIDIA's revenue came from the data center business, a category that barely existed when he made the initial bet. Thinking big requires a leader to have the inner anchoring to absorb short-term public criticism and refuse the quick fix. The modern boardroom environment has fundamentally changed. Activist investor campaigns are at record highs, and ethical lapses have become the primary cause of forced CEO exits globally. In response, elite companies like Apple and Microsoft are replacing chaotic, high-pressure executive horse races with a designed transition process. A designed transition is an always-on process that starts years before a handoff. It involves rotating internal candidates through various profit and loss roles and using deep psychometric testing to look past the interview presence. High-performing boards are increasingly finding their future leaders inside the company, identifying the people doing unglamorous work long before an external search firm is ever necessary.